I was having coffee with a former central bank governor 3 weeks ago when he said something that made me put down my cup and lean forward. When I was in office, we secretly purchased 240 tons of gold over 18 months and told absolutely no one until we were legally required to disclose. Not our legislature, not our finance minister, not even most of my own board. Why? Because the moment other central banks knew we were buying gold heavily, they'd understand we no longer trusted the dollar reserve system, and that loss of trust spreads like contagion. Gold isn't just an asset central banks buy, it's a vote of no confidence in the current monetary system that they can't cast publicly without triggering the very crisis they're preparing for. That conversation sent me down a research path tracking global central bank gold purchases, and what I have discovered over the last 3 weeks is that countries are accumulating gold at the fastest pace since 1967, spending over $130 billion in the last 18 months and doing it as quietly as possible. Because the moment everyone realizes trust is fading, the system, they're losing trust and collapses completely. Let me walk you through the data, because the numbers tell a story that central banks desperately do not want publicized, but can't completely hide. According to the World Gold Council, central banks globally purchased 1,037 tons of gold in 2023 and are on pace to exceed 1,200 tons in 2024. To put that in perspective, 1,000 tons of gold at current prices represents approximately $68 billion. Over 2 years, we're looking at central banks spending over $130 billion accumulating gold. But here's what makes this remarkable. Central banks are supposed to hold reserves to maintain confidence in their currencies and financial stability. When they shift from holding dollars, euros, and bonds into holding gold at this scale and speed, they're making a statement about what they trust to preserve value. And that statement is not the dollar system. I created a graph showing annual central bank gold purchases over the last 25 years, and the visual is genuinely striking. From 2000 to 2009, central banks were net sellers of gold, selling an average of 400 tons annually as they believed the dollar and modern monetary systems had made gold obsolete. Then 2010 marked an inflection point, and central banks became net buyers averaging 300 tons annually. By 2015, annual purchases hit 500 tons. In 2020, 600 tons. In 2022, 900 tons. And in 2023, 1,037 tons. The trajectory is exponential, showing not just increased buying, but accelerating buying, which suggests urgency rather than routine reserve diversification. When central banks accelerate purchases of any asset, it signals they see risks materializing faster than previously anticipated. I needed to understand which countries are driving this buying surge and why, so I compiled data from central bank disclosures, IMF reserve reports, and trade data showing gold movements. The results reveal a clear pattern. Countries buying gold most aggressively are those either sanctioned by the West, worried about potential sanctions, or seeking to reduce dependence on the dollar system. China has been the largest buyer, adding approximately 435 tons to official reserves over the last 2 years, though many analysts believe their actual purchases are far higher, since China doesn't always report purchases immediately. Russia, despite being heavily sanctioned, continues buying when possible and has increased gold's share of total reserves from 23% to 31%. India added 160 tons. Turkey added 220 tons. Poland, Singapore, and several Middle Eastern central banks have quietly accumulated significant quantities. What unites these buyers is concern about dollar system reliability and desire for reserve assets that cannot be frozen, sanctioned, or devalued by another country's policy decisions. I interviewed Dr. Catherine Martinez, who spent 12 years working at the IMF and now teaches international monetary economics at Georgetown. And her explanation of why countries turn to gold when trust fades was both clear and disturbing. Gold represents the ultimate reserve asset because it has no counterparty risk, she told me during our video call. When you hold dollars, you're trusting the United States government and Federal Reserve to maintain dollar value and honor dollar obligations. When you hold euros, you're trusting the ECB and European political stability. When you hold another country's bonds, you're trusting their fiscal discipline and willingness to repay. But gold is just gold. It can't be printed, it can't default, it can't be frozen in your account by sanctions, it can't be devalued by another country's policy mistakes. When trust between nations erodes, when countries worry about financial weaponization or monetary instability, gold becomes the only asset that doesn't require trusting anyone else. That's why central banks buy it when trust starts fading. The graph showing the relationship between geopolitical tension and central bank gold buying is remarkably correlated. I plotted major geopolitical events over the last decade against quarterly central bank gold purchases, and almost every spike in gold buying follows shortly after major trust-breaking events. After Russia's 2014 Crimea annexation and subsequent Western sanctions, central bank gold buying jumped 47% in the following year. After the 2018 US-China trade war escalation, buying increased 33%. After the 2020 pandemic revealed supply chain dependencies and financial system fragility, buying surged 61%. After the 2022 Russia-Ukraine war and unprecedented Western sanctions, freezing Russian dollar reserves, gold buying hit record levels. The pattern is undeniable. When countries witness financial weaponization or system instability, they respond by accumulating the one asset that sits outside that system. I spoke with Marcus, a former sovereign wealth fund manager who now advises central banks on reserve strategy, and his perspective on the current gold buying surge was delivered with obvious concern. What's happening now is different from previous periods of central bank gold accumulation, he explained carefully. In the past, countries bought gold as portfolio diversification or as a hedge against inflation. What we're seeing now is defensive positioning against systemic dollar risk. Central banks are looking at $133 trillion in global debt, most of it denominated in dollars or dependent on dollar liquidity. They're seeing the U.S. government running $2 trillion deficits. They're watching the Federal Reserve's balance sheet that expanded from $800 billion to $9 trillion during COVID. They're recognizing that the mathematics of this debt requires either default, which won't happen, or inflation, which will. And they're positioning their reserves accordingly. Gold can't be inflated away by U.S. monetary policy. That's the whole point. What makes the current gold buying so significant is understanding the constraints central banks face that make their actions even more revealing. Central banks can't just announce they're massively increasing gold reserves without sending signals that could destabilize markets. If the People's Bank of China announced tomorrow they were shifting 20% of their reserves from dollars to gold, that would trigger dollar selling, bond market panic, and potentially financial crisis. So they do it slowly, quietly, often through undisclosed purchases that only appear in official statistics months later. The fact that despite these constraints, despite the need for secrecy, despite the diplomatic sensitivity, central banks are still buying gold at the fastest pace in 57 years tells you how serious their concerns have become. The trust erosion is severe enough that they're willing to risk the very market instability they're trying to avoid by signaling through gold purchases that they see major problems ahead. I obtained internal documents from a European central bank leaked to me by someone concerned about lack of public awareness of these risks and the reserve strategy. Discussions reveal thinking that should alarm every American who assumes dollar dominance is permanent. One memo from a reserve management meeting stated, while public statements will continue emphasizing confidence in dollar reserve system and transatlantic partnerships, prudent risk management requires acknowledging scenarios where dollar access becomes unreliable due to sanctions, policy inflation concerns, or fiscal crisis. Gold allocation should increase from current 9% to target range of 15 to 20% over 36 months through discrete purchases that minimize market impact and political sensitivity. Another document outlined contingency planning for rapid reserve reallocation in crisis scenarios where dollar-based assets become impaired or inaccessible. The industrial and central bank demand collision happening in gold markets adds another dimension that explains why prices keep rising, despite economic headwinds that traditionally pressure precious metals. I created a chart showing annual gold demand from different sources over the last 5 years. In 2019, total gold demand was approximately 4,300 tons annually, with jewelry accounting for 2,000 tons, investment demand around 900 tons, central bank buying 400 tons, and technology DOS industrial use about 300 tons. By 2024, total demand has increased to approximately 4,800 tons, but the composition has shifted dramatically. Jewelry demand declined to 1,700 tons as higher prices reduced consumer purchasing. Investment demand stayed relatively flat, but central bank buying exploded to over 1,200 tons, and technology demand increased to 400 tons, driven by electronics and green energy applications. The shift from price-sensitive jewelry demand to price-insensitive central bank buying changes the fundamental supply-demand dynamics of the gold market. I interviewed James, who trades gold for a major commodity fund and has been in precious metals markets for 28 years, and his assessment of what central bank buying means for prices was bullish in the extreme. When central banks become the marginal buyer in any market, price dynamics change fundamentally, he explained with obvious excitement. Central banks don't buy based on price. They buy based on strategic need. If China decides they need to increase gold reserves from 4% to 10% of total reserves, they're buying regardless of whether gold is $1,800 or $2,500 per ounce. That creates a price floor that keeps rising because central bank demand is essentially unlimited at current reserve allocation levels. Meanwhile, annual mine production is basically flat around 3,400 tons and can't increase significantly. You have inelastic supply meeting price-insensitive demand. The result is structurally higher prices over time. The only question is how fast central banks want to accumulate and how much they're willing to push prices up in the process. The geopolitical implications of this gold accumulation extend beyond just reserve diversification into questions about the future of the monetary system itself. I spoke with a former Treasury Department official who worked on international monetary policy, and their analysis connected the gold buying to broader shifts in global power structures. The countries buying gold most aggressively are the same countries building alternative payment systems outside SWIFT, trading in currencies other than dollars, and forming economic blocs that deliberately exclude or reduce Western participation, they explained soberly. BRICS nations discussing gold-backed trade settlement, Middle Eastern countries accepting yuan for oil, Asian nations building regional payment networks. All of this is happening simultaneously with record gold accumulation. This isn't coincidence. Gold is becoming the settlement asset for a parallel financial system being built by countries that no longer trust or want to depend on the dollar system. The gold they're buying now is the foundation for that alternative system. When trust in the existing system falls below a critical threshold, that alternative becomes operational. What keeps me awake after researching this topic is understanding the feedback loop that makes trust erosion self-reinforcing. When countries lose trust in the dollar system, they buy gold. When they buy gold, it signals to other countries that trust is eroding. When other countries see that signal, they lose trust and buy gold themselves. The buying accelerates, the signal strengthens, more countries join, and the trust erosion speeds up. We're watching that loop in real time. Central bank gold buying in 2010 was 300 tons annually. In 2024, it's over 1,200 tons. If the trend continues, 2027 could see 2,000 tons of annual central bank purchases. At that level, with flat mine production and growing industrial demand, gold prices would likely need to reach $3,000 to $4,000 per ounce just to bounce the market. And at those prices, the signal that trust in the dollar system is collapsing becomes impossible to ignore, potentially accelerating the very transition that central banks are positioning for. The conclusion I've reached after tracking global central bank gold purchases and analyzing what drives them is that we're witnessing the slow-motion unraveling of the dollar reserve system that's dominated global finance since 1944. Countries aren't buying 1,000 tons of gold annually because they think it's a good investment. They're buying because they're preparing for a world where the dollar doesn't function as universal reserve currency, where Western financial institutions can't be trusted not to weaponize access, where monetary stability requires holding assets that don't depend on any other country's policy choices or political decisions. The trust that underpinned dollar dominance, a belief that the United States would always honor dollar obligations and maintain dollar value, is eroding visibly in central bank reserve allocations. And once that trust falls below a critical level, the transition to a new monetary system becomes inevitable rather than theoretical. The ending I want you to understand is that gold purchases by central banks are a leading indicator of trust levels in the international monetary system. And right now, the indicator is flashing warning signals that should concern every American. When countries that hold trillions in dollar reserves are quietly shifting billions into gold as fast as they can without triggering market panic, they're telling you something about what they see coming. When internal central bank documents discuss scenarios where dollar assets become impaired or inaccessible, they're planning for outcomes that sound extreme until you realize they're the people with the best information and the most to lose if they're wrong. The gold buying isn't about profit, it's about survival of national reserve assets when the current system fails to deliver the stability and reliability it promised. 1,000 tons annually today, perhaps 2,000 tons in 3 years. Perhaps emergency accumulation when the next crisis hits and trust doesn't just fade but collapses. The central banks are voting with gold purchases. They're voting that the dollar system's days as unquestioned global reserve are numbered. And if you're paying attention to what they're doing rather than what they're saying, you might want to consider what that vote means for your own wealth and how you preserve it when trust fades and gold becomes what countries reach for because nothing else can be trusted anymore.